Hello, people. This is Craig, and welcome back, I guess. I know what you're wondering is, where have you been? It's been over a month since you made an episode. I didn't get COVID. I didn't get sick. Neither is Janice. Everybody's good. What it was is that I got really into researching different types of investments to protect my wealth, Janice's wealth, from what I suspect will be super inflation in the not too distant future. And one of the areas that I already owned since August of 2018, but kind of just bought it on a whim, threw it in one of these crypto accounts and just forgot about it, figuring it's just there in case, was cryptocurrency. And now I've subsequently gotten really deep. There's a lot to know and learn about cryptocurrencies and things you can do to make income off cryptocurrencies. It's an amazing world, but it takes a lot of time to research all these different altcoins, what's good, what's bad. There's a lot of bad ones out there. I don't know how many thousand coins are available on the market, but I'd say at least half of them are complete garbage. But there's a lot of good ones too. And we'll talk about that probably in a future episode. But I wanted to talk mostly about the number one thing. Now, if you own a boat, which is most of the people who watch the Cruising Off Duty YouTube channel, you know that BOAT stands for break out another 1,000. And that's because boats cost a lot of money to maintain, especially if you're a power boater, especially a big cabin cruiser type of power boater. The fuel for a weekend of buzzing around in your cabin cruiser is, well, it blows your hair back when you see the bills. Sailors a little less so, but we still have things like sails we need to replace, running rigging, maintenance, engine overhauls, who knows what's going to go on a boat, but it's not a cheap hobby or a lifestyle. So anybody who's been watching that channel should have some interest in wealth preservation or growing your wealth and the different options. And we're going to talk today about the upcoming inflation that I see coming. I'm going to give you a PowerPoint presentation. But before you comment, because I know this happened, I did an episode very similar to this in February 2020, right before the market crash, when COVID hadn't even been decided by the World Health Organization. It was a pandemic yet. Markets were at all-time highs. And in February, I came on and said, stocks are way overvalued. Bonds don't pay any interest. But you need to get yourself out of stocks that are way overvalued, because I think this COVID or coronavirus was what they were calling it back then, is coming from China to our shores very soon. And when it does, the economy is going to take a major hit, and that's going to be the pin that breaks the bubble of these overinflated stocks. Now, a lot of people appreciated what I was saying. It was a word of warning. You know, I'm not your financial advisor. I was just saying what I'm doing, and learn from some of the things I've researched. A lot of people liked it. A few people didn't. And the comment from people who didn't like it was, A, who are you to tell me about investments? And I'll talk about that in a second. And the second one, which I get, is they said, I didn't subscribe to the Cruising Off Duty YouTube channel to talk about investments and inflation and all these things. I totally understand that. And that's why today I'm going to announce that I'm starting a second channel called Investing with Craig. So it's going to suck because I have over 33,000 subscribers here. So when I put all the time and effort into making an episode, at least when I put it on the Cruising Off Duty YouTube page, it's going to get some views. It's going to get whatever number of thousand views. And at least it makes me feel like the investment in time was worth it to try and teach people some of the stuff. And talking about teaching people some of the stuff, when people say, who are you to tell me about investments? Actually, I don't know if I mentioned this in the last episode. My education is, I've got a commerce degree in investment and finance, and I was actually a financial planner prior to my present career. So I know a lot about sitting down with families and helping them plan for their future, whether it's their future retirement or their kids are going to need to go to university and they want to get an account set up for that. And I would sit down and make I do spreadsheets for them saying, based on putting away X number of $100 per paycheck, you can get this goal satisfied, this goal satisfied. So I've done a lot of that. And a lot of my factors that I had to take into account was what we expect inflation to be, because that's the big tax. And that's what this episode is going to be about, is how inflation is the hidden tax that you don't see, but that is sapping your wealth, and how we can make some smart choices on different types of investments that have been proven over time to be a good inflation hedge, if not a wealth builder, something that builds faster than the inflation is eating away at your purchasing power. So hopefully you look forward to that. After you watch this episode, just this is going to go on the Cruising Off Duty channel, and it's going to be my very first episode on the Investing with Craig channel. So hopefully some of my subscribers from here will go over there and subscribe, because a lot of the investing stuff that I'm talking about here going forward will only be on that channel, so that I don't upset my cruising off duty subscribers, who some of which get very offended when I talk about finances. Anyways, it is what it is. And I'll put all of that content over there. So let's get on to a PowerPoint presentation that I've created for you guys. Hopefully you enjoy it, or at least learn something from it. If so, like usual, hit the thumbs up button just to let YouTube know that it was worth your time, and they'll suggest it to more people. Okay, so let's talk about inflation. And to me, it's just clearly obvious that crazy high inflation is here already and going to get worse. And I don't understand how the federal government, now I'm going to use a lot of American numbers because America is the biggest economy in the world. I am Canadian, but let's be honest, Canada's number one trading partner is America. So if America falls apart, Canada's going to go down with the sinking ship at the same time. So I'll say we a lot when I talk about American numbers, even though I know a lot of you know I'm actually Canadian. But anyways, let's go with inflation. So easy to find this stuff. Steel in the last year has gone up 145%. Lumber's gone up over 300%. And that's this graph down here, actually. I just cut and pasted that in there just to show you where I got that number from. Lumber a year ago was below $300 per whatever metric square cubic, whatever they measure it in. And now it's over 1,000. So that's over 300% on lumber, which is what people, when they get new houses built, it's super expensive to get a house built now. Because of lumber, because of copper, because of all the other things that go into building a house. Copper up 68%, oil's up 80%, corn, there's where the food inflation's coming. Corn is up 65%, soybeans up 71%, wheat's up 25%, and the food and index, which I think is a government number, says it's food's up. They'll at least admit that food's up 25%. So is over here on this side here, you're gonna see. So how does the government keep telling us that inflation is not a problem and it's under 2%? It doesn't make any sense. Let's just call a spade a spade. The government lies. The government is lying to you. I don't know if that's going to surprise anybody, but they're trying to keep everybody calm by telling you that inflation isn't here when it quite clearly is here. When you go to the grocery store and you see how much one single steak costs, or you bought a case of pop before and it used to cost you $5 and now it costs $8. Or you know what I mean. You've seen it. I know anybody who's shopped at all has seen that. So there's two areas that inflation becomes really apparent. Obviously in your everyday purchases, but inflation often goes to assets as well. So what happens is too many dollars chasing too few products is what causes inflation. But then also extra money that people don't need for food and not goes into other assets. Bitcoin, the cryptocurrency I was talking about, is up 1,400% in the last year. And a lot of the altcoins are up even more than that. Home values. This number doesn't even seem right to me. I picked this number out of one of those government statistics. It says it's up 15% in the last year. I think it's more than that. Here in Ottawa, case in point, I just saw in the news, a Ottawa house sold for $450,000 over asking. The house was asking $8 million and ended up selling for $1.25 million. And another couple had bid $425,000 over asking and didn't get the house. Can you imagine? Can you imagine bidding $425,000 over asking and getting outbid? Insane. Down in Toronto and York, actually, another example, a house sold for $625,000 over asking. So things are going mental when it comes to house prices. I don't know how any of these millennials are ever going to afford to live in a house. If they don't already own one, yeah, they're going to be renting for the rest of their life unless we get a housing collapse, which isn't going to help people like you and me that own a house, but it will help those poor millennials that are getting left at the train station. The train's left and they're not on it. And another area that's gone up is gold. Gold, actually, when I did my February 2020, telling people to get into gold stocks, we'll have physical precious metals like gold and silver. Gold was, I think, around $1,400 a share. Gold went all the way up to, I think, $2,200. I look like Nostradamus because it went straight up as soon as I started saying that. And the market that I said was going to collapse because of the bubble burst of coronavirus coming to our shores went down 35%. And even though there's people complain that why are you talking about investments on a sailing travel channel? I started getting a lot more comments after the collapse of the stock market. They're like, damn, you nailed it. So I don't know if I'm going to nail it as good this time, but it is what it is. So one of the reasons is too much money chasing too few assets. Look down here, the money supply, M2, by the Federal Reserve, then again, a government number, so you can never fully trust it, but even they admit that the money supply has gone up exponentially. Like I think it's the number is up 40% in the last year. That's insane. So the main problem is fiat currency, which stands for fiat, could be called fake currency. It's not backed by anything. It's just backed by the government's faith that they will pay it back. And that's fine, but as has been proven hundreds and hundreds and hundreds of times by countries, governments are generally terrible money managers. They tend to spend more than they make, and then to get themselves out of a bind, they print more money because it's fiat. It's the government just prints it on a printing press. And then they give it out to their, people get upset that inflation's going up and that they can't afford food, so they just give out free money. Like the U.S. government is now. I mean, $1,400 to every man and woman, that even when they don't need it, even if they're working, well, it doesn't matter. $1,400 for you, $1,400 for you. You got 3 kids, $3,000 each. There's another $9,000. I mean, who's paying for this? I mean, I know some people legitimately need it, but some people didn't. And as I'm going to show later in this thing, a lot of people just took the money and put it right into the stock market or into Bitcoin or into some other area, causing more asset inflation. So these are just the countries down here. You can see Zimbabwe, Venezuela, Argentina, well known in the media if you've been following it. All these countries constantly having inflation. They reset their currency. They call it another name for the currency. And within a few years, they're back in the same boat, inflation, because governments can't be trusted. They will print more than they want to buy your votes, right? So if they got the printing press in the back room, every time the public is upset or a new election's coming, they promise the world, we'll give you this, we'll give you that, free healthcare, free this, free that. Yeah, but who's paying for it? Just goes on the debt. And eventually the inflation hits and then the currency isn't worth much. Generally, it's just saying that people start to see the inflation and it's like a snowball rolling down a hill. You get a little bit of inflation, people start to realize, every time I go to the grocery store, it's more expensive than the last time. If it changes every week, you start to notice that and you go, wait. I'm taking my paycheck the minute I get it and I'm running to the store and I'm buying canned food. I'm going to buy whatever I can for the next month because I'm afraid by the time I get it next month, it'll be a lot more money. So there you go. That's what happens. And once everybody starts running to buy everything they can the minute they get their paycheck, we turn into hyperinflation. Okay, when you look at that list, you might think, okay, it's all third world countries, right? Well, Argentina, I wouldn't really say is a third world country, although they've mismanaged their currency so many times. I think they've defaulted twice already. But it looks like it's mostly third world countries, but that's not always the case. There's been many powerful empires in the past that have actually collapsed mostly due to financial reasons. Think the Roman Empire, think the British Empire or the Persian Empire. They were all powerful empires, controlling broad sections of the earth. And it wasn't because they were beaten on the battlefield that stopped them being this powerful empire. Eventually, they just couldn't financially afford to keep troops in every one of these countries they took over to police the people. And if nothing else, to placate those people they took over, they would give them stuff, which cost them money. So long and short, like most recently, the British Empire, as you know, if you know anything about history, British Empire spread far and wide. Everywhere. India was part of the British Empire. Canada was part of the British Empire. Australia, New Zealand, I think so many countries were really part of Britain at one point, not even self-governed. And the British Empire eventually, just under financial strain, started giving countries back their sovereignty. So that was a financial reason more than, like, Canada didn't have a war against Britain. Canada just asked for their sovereignty and Britain didn't want to pay to say no. So we got our sovereignty. So again, proving it's not just third world countries. Look at another example. The Weimar Germany was Germany prior to World War I. Now, in World War I, Germany lost, and there was a treaty signed that said because Germany lost the war, they had to pay reparations to all the countries that had lost men during the war, and their economies were hurt during the war. So they took it out on Germany and said, you got to pay us all this money. So what happened was in January 1919, 1 ounce of gold cost 170 marks. Now, this is after the war's over because inflation hasn't really taken hold yet. That snowball hasn't started rolling down the hill yet. And as you can see, within 6 months, it's 499. Within another 6 months, it's 1340. And you go all the way down to the bottom by November 30th, 2023. So we're talking, 3 years later? It cost 87 trillion marks to buy 1 ounce of gold. And just as a point of interest, at the bottom here, you'll see, this is the reason that Hitler came to power. and started, what happened to cause World War II. He came to power because, let me show you the next screen here. This is what it looked like in Germany. This guy up here, there's so many marks. It wasn't even worth the sales girl to count it. So they used to weigh it to tell how many marks the guy had paid. Down here is this lady's putting marks into her wood stove to heat her house because the marks are so useless that they're better for burning than they are for anything else. And these kids are making a kite out of marks. So that just goes to show you that the printing press in Germany was going nonstop, and they were just giving money to people to placate them to the point that the money was eventually worth nothing. Okay, here we are talking about the most recent empire, the British Empire. The question is, it couldn't happen to the USA, right? Because we are the world reserve currency. Well, prior to World War I, the British Empire had the world reserve currency. The British pound was what everything was denominated in. When you wanted to buy assets, it often was priced in the British pound. And just so you go to show you here, this is Canada. We'll see the arm flash there. That's Canadian. So we were part of that prior to World War I. And they are no longer the world currency because, well, like we talked about, financial collapse. The US became the world reserve currency, and mostly it was because they were the most stable, perceived as the least risky currency at the time, even after World War I and whatnot. So they used to actually be under the gold standard. Here's a certificate right here that said it right on the face of it. This is a $100 certificate that says redeemable in gold coin. There you go. So everybody thought, yeah, Britain's having financial problems. Let's stop denominating things in pounds. Let's start denominating everything in US currency. And the reason they need to pick a currency is because if you're a sheik in the Middle East and you want to sell oil, you don't want every customer coming to you with a different currency and you have to figure out what your oil goes in that currency. So it became just understood that everybody's going to buy my oil in American dollars. And gold is priced in American dollars and whatnot. And then when the person gets the money from selling the oil, they would just hold it in American dollars, because when they needed to buy another asset other than oil, they would then turn around and use those US dollars again. So it was just easier for world exchange to have one currency that everybody sort of agreed was the world exchange currency. And because it was backed by gold, gold was pegged at $35 an ounce. And for a long time, this situation worked out great. But here's kind of like the rise and fall of the US dollar. So a few interesting things here. So the US dollar back in 1913, they started it here because that was when the Fed was created, the Federal Reserve. And the Federal Reserve was given the powers by the government to be in charge of, in essence, printing money, if needed, to buy bonds or do whatever it needed to fight inflation. That was their only mandate. They didn't care if the stock market went up. That wasn't part of their mandate. It was to keep the economy moving without inflation. But they didn't care about deflation back then, which is actually a good thing. We'll get to that in a second. But as you can see, during the First World War, there was a lot of money spent. So the US dollar, even though it was backed by gold, fell. But keep in mind, up here in 1913, so back here in 1913, $100 would buy you 5.2 ounces of gold, because in 1918, gold was actually $18.92 an ounce. They hadn't pegged it at $35 yet. World War I happened. Now, as you can see here, the US dollar actually got more purchasing power all the way through, even through the Depression of the 29s, because they actually let the US dollar, instead of inflation, they had deflation, which means that the dollar bought more than it did the year before. So it actually gained in value, as I guess in comparison to other countries that were losing value. Then it goes on and it starts to fall. Now this is World War II here, Bretton Woods Agreement, starts to fall, mostly because, especially for World War II, they started printing money to foster that war machine, to build more tanks, more planes, whatnot. And when they don't have the money in the government coffers, they would just ask the Fed to print more money. So they did. They printed more money. Over here was the Vietnam War. Obviously, the Korean War was in here before that. Vietnam War was kind of the breaking point. And in 1971, a lot of other countries were starting to realize that the U.S. kept printing money and they were losing trust. But they knew that their money was exchangeable into gold. So a lot of other countries who had American currency started going to the U.S. and saying, I want my gold. And they realized, oh, crap. We don't have enough gold for all the people that have our dollars. So they ended up taking the gold standard away in 1971. I believe it was Nixon. So from that point, we became a fiat currency. So they would just print to the detriment of the purchasing power of the US dollar. And as you can see, all the way through the .com, all the way through the Trump time, I believe, it doesn't really show it here, it's so small you can't tell. I believe it got down to, the purchasing power of the dollar was down to 3 cents. So you've lost 97 cents of the purchasing power of a dollar back in 1913. But as I mentioned over here, back in 1913, you could buy 5.28 ounces with $100. If you bought those 5.28 ounces and you sold them in 2020, which is about where this chart ends, the price of gold was $2,050 in 2020, which means you actually had the purchasing power of $325. So it goes to show you that if you just took the money, the $100 back in 1913, bought gold and buried it in your backyard or put it in a safety deposit box, you actually, even with the crazy inflation, you actually still had higher purchasing power than you did in 1913. So talking about that deflation again, as you can see here, here's the inflation rates. This is World War I, so inflation went a little crazy. But then after the World War I, the Federal Reserve didn't care if the economy went into deflation. In fact, back then, I think they almost thought, like I do today, deflation's a good thing. So if I have $100, if my salary is $100 a week, and I can buy X amount of goods with that $100, but then a month later, 2 months later, I can buy more goods with that same $100, then you don't need to ask for a raise from your boss. You just feel like, hey, things are good. I don't need to buy stuff I don't need now. I'll just wait because chances are next month it'll be a tiny bit cheaper at the grocery store. So that's actually a good thing. It's the opposite of a tax. Now you might be wondering, why hasn't that happened since then? You got to remember, back here, the US was a creditor nation, which means governments owed the US money. The US didn't have money owing to other countries. They had a surplus. So everybody was paying the US. So they said, hey, deflation works to our benefit because we're getting dollars in the future that are worth more than the dollars are today. That hasn't been that way for a long time, as you can see here. The US have been a debtor nation ever since. They've been spending money, and their trade between countries, especially like China, is that we send them $1 million worth of gear and they send us $2 million worth of gear back. So we always end up owing them money to pay for all those goods that we have. So there you go. So you might wonder, why do I say the government is lying about inflation? Well, here's the thing from Shadow Stats. It's a good website to go. They'll explain it all there. I just grabbed this chart out of it. It shows that inflation, the way Shadow Stats shows it or calculates it, stayed exactly the same as what the government said all the way to the early 80s. And then in the early 80s, the government started to fudge the numbers. They started to say, we don't want to show people that inflation back in 1979 was 15%. Can you imagine today telling people that inflation is 15%? Crazy. They started to change the way they calculated the CPI. They started taking out all the things that would actually really pump it up. They started taking out food. They started taking out fuel. They started taking out a lot of things that you and I have to use every day or buy every day just to live. They took that stuff out. And then they also started doing these deflator calculations where they'd say, technology being the prime example, a TV you buy today versus a TV you buy next year, chances are the TV you buy next year has a few more features, or maybe it's even gone from 1080p to 4K. They say, because TVs have gotten better year over year, they have more value. Therefore, it deflates what inflation is, because even though you paid the same or maybe even slightly more for next year's TV, you got a much better TV. So it's deflationary. So they subtract it from the number. So as you can see, they changed the numbers a little bit in, I think, around 81, 82. And then in 88, right around here, they changed it a lot. And then you can see how they did more fudging of the numbers, different calculations. And then you can see how the numbers just start to get apart. So the Shadow Stats uses this, as you can see, based on the way 1980 used to calculate inflation. So they've kept calculating it that way. And the red number is what the government tells you in the news every whatever month, what inflation is. And it's just a bald-faced lie. So real inflation is right now, if this is up to date, it's around 9%. In the not too distant past, it was above 10%. And so I always go with, let's just assume going forward, especially with all this money printing, we have to assume there's going to be at least a 10% inflation. Another number that they constantly lie about is unemployment stats. The red number is what the government tells you. And as you can see, back in the COVID, March collapse, they'll admit that unemployment got up to about 15%. Shadow stats, the way they're calculating it, with the real unemployment, when people are not working but want to work, they're unemployed. But the government comes up with all these rules as to how you actually stay considered unemployed. But the shadow stats number was over 35%, which was higher than it was during the 1929 Depression. So why is the number so different? Well, the government takes out what they call discouraged workers. You have to constantly prove with letters from companies you've applied to that you've been trying to find work. If in the last 4 weeks you haven't documented to the government that you've tried to find work, they call you discouraged. You're a discouraged worker. You're not really trying to find a job anymore, which you might be trying, but you just haven't got documentation. They take you off the unemployment roll. People wanting to work full-time but can't find a full-time job, they can only find a part-time job. Let's say they're working 10 hours a week, not considered unemployed. In fact, if you work 1 hour a week, you are not considered unemployed. People who are underemployed don't count as unemployed, of course. People who are, let's say, a master's in engineering, and you cannot find an engineering job to save your life, and you end up, just so that you can pay for food, you end up working at McDonald's flipping burgers, you are considered employed. It doesn't matter that you are far underemployed for your education and your skill level, you're still considered fully employed. And you can tell the numbers are fudged too when you see that the number of people employed week over week goes down, but the unemployment rate also supposedly goes down. How did that happen week over week or month over month? It's just a bunch of BS. So anyways, just so you know, the government, why would the government lie? People always say, oh, come on, Craig, they're not going to do that. What would be the point? Well, there's a lot of points. First of all, especially about inflation. People in government, private pensions usually have a cost of living stipulation in their thing. So when you get a pension and it says you make, $50,000 a year on pension, it'll say, plus every year you'll get a cost of living increase, which is based on the CPI, which is the government's, calculation of what inflation is. So all those government pensioners only get a raise based on what the government tells them is the inflation rate. So it's in their best interest to say inflation's 1.8% when it's actually 9%. Because then they don't have to pay everybody 9% more. And a huge number of people work directly or indirectly with the federal government, whether they're military, whether they're just municipal employees, state employees, federal government employees. So when they go back for their yearly, let's talk about what my wage should be, negotiation through their association or whatnot, a lot of times the government will come back and say, okay, to be fair, we'll give you a cost of living increase. So again, if they say it's 1.8%, they only have to pay 1.8%. If they admit it's 10% and they only offer 1.8%, then people will start striking and it'll just get messy. And so they don't want to do that. And again, keeping the just general public, even if it's not a government employee, placated. They don't want mass panic. They don't want to tell people, sorry, everybody's getting probably on average a 1 or 2% raise every year on average, but inflation's 10%. Because people will lose their mind. So that's the main reason. They just want to keep everything calm. So this is even a bigger reason, other than just paying their employees less and whatnot. The biggest thing is they have printed themselves a crazy debt amount. You'll see in the debt clock I'll show you in a second is over $28 trillion. Again, government numbers, it might be higher than that. Just the federal debt, not the state debt, not the municipal debt, not personal debt, just the federal government debt is $28 trillion. So we'll get to that in a second. So that is such a huge number. It's more than the GDP of the entire country. That if they have to pay the fair rate for interest on that, let's say 8%, 9%, they would literally not be able to handle the interest charges. So they have to lie to keep the debt payments low as possible, like as close to zero as they can right now. So the Federal Reserve pegs their overnight exchange rate at 0% right now so that they can keep refinancing those government bonds at nearly 0%. So that's the reason that they also want to deny that there is any inflation. So here's the debt clock. This is just a screen capture of it. So this thing normally, if you go on this website, usdebtclock.org, it's kind of humorous to watch this number just spin around, going bigger and bigger by the second. 28 trillion for US debt. Down here, state debt is over 1.2 trillion. Local municipal debt over 2 trillion. It's just insane how much debt there is. I don't know where I got household assets here. I don't know if I can see household debt, but household debt is also very, very, very high. Okay, so let's just see how inflation is a tax. So let's just start. You got to have some round numbers. So say in the beginning of 2012, you had an income of 100,000. Nice round number. Maybe it's not just you. Maybe it's you and your wife or your spouse have a combined income of 100,000. Well, let's just go with that. So in 2012, you had 100,000. Now you have to decide how much is the government fudging these numbers. If you think, come on, Craig, they're not fudging them that much. I'm only going to say it's a 3% inflation. Then go to the bottom. In 10 years from now, the $100,000 you're making will have a purchasing power of 74,000. If you think it's more like 5%, you have a purchasing power of 61,000. 7%, 50,000. If you think it's the full 10%, $38,000 in purchasing value in 1 decade. It's not that long, 10 years. And of course, if hyperinflation starts to rear its ugly head and I go all the way up to 15%, then your purchasing power of $100,000 in a decade is $24,000. Sometimes people have a hard time understanding purchasing power in the future. So let's go in the future with what kind of raise would you need to have to keep up with purchasing power. Again, using the same thing. If you think inflation is only 3%, you need to have your income go from $100,000 to $134,392 in a decade. That seems like a lot. That's 35% increase in your salary. I don't know if too many people are getting that raise right now. The only time you're going to see your income go up that much is if you get a promotion to a higher ranking position, then maybe. Again, if that's the best case scenario. If you're saying 5%, you need to make 162, 7%, 196, go the full bore, 10%, you got to make $259,000 in a decade from now. I don't think anybody's getting that kind of raise at work. So we are actually losing purchasing power, which is again why I call it inflation is that hidden tax. So here's the end-all question. How do you keep up with inflation if your paycheck isn't doing it for you? If you're not getting enough of a raise to keep up with the 5, 6, 7, 9, 10% inflation? Well, in the past, the best bet was invest your savings in stocks because stocks generally had a higher rate of return than inflation. And over the last, 12 years, stocks have done really well. So you've been keeping up with inflation and then some. The problem is if you have money today, you're brand new, you're one of those millennials, you're trying to put money into the market now, I don't think it's a good time. Stocks are so overpriced, and I'll get into that in a second. So right now, stocks are just in bubble territory, and I'm worried for those investors who start now, slam in as much money as they can, trying to make up for inflation, and then the market pulls back 50%. It's going to be nasty. Bonds, let's be honest, they're paid almost no interest right now, so not going to keep up with inflation. Gold and silver, as we showed in that since 1913 to now, gold does more than keep up with inflation. So that's a good option. That's why in that last video in February 2020, I said, get yourself some physical gold, get yourself some silver, get yourself some gold mining stocks because they are a leverage play on gold. So if gold goes up $100, they'll go up 10%, as you know what I mean? So it's gold goes up, those stocks go up even more. And now a new area that I didn't talk about before is cryptocurrencies. They're a good option. Back when I bought them in August 2018, I threw $10,000 in to cryptocurrencies, Canadian dollars. And I got a little bit over 1.22 Bitcoin. And then I took that Bitcoin and I split it into a bunch of altcoins and I kept a little bit of Bitcoin. That has done, I think, 750%, maybe more. It's a lot. It's gone up a lot. And now people might say, well, isn't that like the stock market? Don't you think that maybe you're in bubble territory with the cryptocurrency? Maybe. But I got to think it's way less risky to invest in it now because of the mass adoption going on in cryptocurrency compared to in 2018 when a lot of people were like, is this thing going to survive? Is the government going to make it illegal? Are they going to, somehow close down all our crypto accounts? And I didn't know. So I thought, well, I could throw 10,000 in and if it goes to the moon, great. If it doesn't, it's not the end of the world. If I lose it, I lose it. It was really highly speculative money in my mind. It paid off in spades. I wish I put a lot more than $10,000 in it, knowing what I know now. But yeah. So here's just just talking about whether we're in bubble territory, here's the S&P 500. So this is the most broad, like you can buy an ETF that does just the exact same thing here. It gets the whole S&P 500. So this is the SPX, and we go from the bottom of the last recession, the real estate collapse of 2008, 2009. So it bottomed in June 2009 at 666 on the S&P 500. Kind of a ominous number, but that's what it was. And just recently, this was as of yesterday, it ended at an all-time high of about 4,020. So that's a 504% return over those 12 years. So I know it's not talking about compounding interest and all that. Oh, and by the way, that's not counting dividends. That's just the stock prices. So a lot of these companies in the S&P 500 pay a dividend too. So you've made that 504% plus all those dividends every quarter you've been paid, which go into your account as cash, and then you can reinvest it into more stocks if you want. So that 504 is underrepresenting what you really would have made, but it's hard for me to know what the dividends would have been. It works out to be about 42% a year. And keep in mind that 12 years is the longest bull market in recorded history. Most bull markets last 8. We're way past 8. So keep in mind, not only are things at bubblicious prices, but this bull market's gone on way, way longer than any bull market has in history. Oh, here's kind of a funny thing. So you think the S&P 500 has done well at 504%. Look at this blue line. That's the tech-heavy NASDAQ. It dwarfs the S&P. It makes the S&P look like it barely went up comparatively. So we'll get onto this in the next slide. Here's the exact same calculations for the NASDAQ versus, well, before it was 504% for the S&P. The NASDAQ went from 1,006, seriously, 1,006. And it just ended, it had a high a couple months ago. And NASDAQ's already started to roll over, of 13,872. So if you go from the bottom to the top, it's a 1,279% return. So I have a hard time when people argue with me that we're not in bubble prices, that no, things are still, we got a long way to grow yet. I'm like, really? 12 years we've been growing nonstop in a bull market that's been longer than ever, and we have had crazy price earnings ratios of almost every tech stock, and you've made 1,279% return, which has got to break records for stock market growth over a 12-year period. Anyways, I'm always shocked when people argue with me that it's not overvalued. Just as a prime example, I use Tesla because I think Tesla is a great company. Don't get me wrong. I love EVs. I love the whole battery technology and yada, yada, yada. But growth at a reasonable price is what I'm after. Tesla is not a reasonable price. So it's fallen. It used to be $900. It's fallen down to $658 as of yesterday. I printed this on the weekend. So this is the most recent price. Look at this. Look at this green arrow pointing to its price earnings. 1,250 times price earnings. 1,250. That is insane. I would think anything over 40 or 50 is considered crazy high, but I mean 1,250 times? Wow. Now you got to say, oh, well, it's going to grow. Well, even Elon Musk, who's probably overly bullish and overpromises and underdelivers all the time, he says it's going to grow at 25%. So even at a company could grow for 25% year after year after year after year, which I don't believe because there's a lot of EV companies, Ford, GM, Volkswagen, BMW, Audi, everybody's coming out with an EV now. And you can't tell me that Tesla has the best quality. They're, in JD Power and Associates, they put Tesla way down near the bottom of the list because of all the problems that Teslas have. It amazes me that there's such a cult following of Tesla for its being the best car ever made. Well, it's not. It's not the best car ever made. And when they have all this other competition from these bigger legacy car companies, I don't think they're going to be able to guarantee that they're going to grow 25%. And they're a long way from the robo-taxi where you can literally take the steering wheel and the gas pedal and the brake pedal out of the car and it'll just drive around, pick people up. We are a long way from that. So can't count on that being their income stream anytime soon. So that's just I know I'm going to get a lot of hate because there's Tesla evangelical people out there that will just hate on anybody that says Tesla's overpriced. Let's go with one that we can all agree is a blue chip tech company, and that's Apple. I love Apple. I always owned Apple until 2019 when I thought things were getting a little too bubblicious back then. And I sold out of it. I used to buy it and then sell covered calls against it for like a month out. I would pick a number way above where it was and say, yeah, if it gets there, I'll be fine selling it to you. But if not, I get to keep the premium. It's a great way to make money. Anyways, I remember buying Apple when it was at 12 times PE commonly because Apple's a huge company. It's hard to move the needle on such a big company. You can't expect a company that big to grow at 10, 20%. Look at the numbers on, I think it's the next page. So right now it's trading at 45 times PE. And you got to remember, this is Apple at 123. It was much higher than that recently. Like I said, the tech stocks have already started to roll over and are starting to fall. But even at this slightly lower price for Apple, it's still selling at 45 times PE. If we go to the next page, 45 times PE, you should be growing your company at 25, 30% to get that kind of PE to make it make sense. Its total revenues have gone up over the last year by 5%. Its gross profit gone up by 6%. Its operating income's gone up by 3.6%. Its net income's before taxes 2%. So you can't tell me Apple is a buy right now. And I love Apple, don't get me wrong. If I could own a tech company, it would be Apple. But it's got to be a lot lower than this. Okay, so I know you're like, Craig, come on. You're being a little pessimistic here. Warren Buffett and Charlie Munger are probably notorious for being the best investors in history. They've always seemed to outperform the S&P 500, which for a money manager is really, really tough to do, year after year, decade after decade. So they are perceived as some of the best investors ever. So let's listen to what Charlie Munger has to say. For those of you that aren't aware, Charlie Munger is the investment partner of Warren Buffett at Berkshire Hathaway. Berkshire Hathaway as an investment firm has had an outstanding record of outperforming the market for many decades. So when Warren Buffett or Charlie Munger speak at a public conference, people listen. At a recent televised conference put on by the Daily Journal, Charlie Munger was asked a lot of important questions about the state of the market today. In the recent Berkshire Hathaway letter to shareholders, you mentioned that you believe the recent share price increase has been fueled by speculative frenzy and forced index buying. How do you believe this will end up, and how do you think investors should cope with these periodic periods of frenzied buying?
Well, these things do happen in a market economy. You get crazy booms. Remember the dot-com boom when every little building in Silicon Valley rented at a huge price, and a few months later, they were about a third of them were vacant. There are these periods in capitalism, and I've been around for a long time, and my policy has always been to just ride them out. And I think that's what shareholders do. In fact, what shareholders actually do is a lot of them crowd in to buying stocks on frenzy, frequently on credit, because they see that they're going up. And of course, that's a very dangerous way to invest.
The next important question that Charlie was asked was if he saw parallels between this market environment and that of the late 1990s, and does he also believe this will end badly? And don't blink, because his answer to this question was very brief.
Yes, I think it must end badly, but I don't know when.
Next, Charlie was asked about the speculation in the SPAC industry. He was asked, it seems like everyone from actors, athletes, singers, and politicians are getting into the business of promoting their own SPACs. What do you think of all these new SPACs and the promoters that are pushing them on the investing public? And in case you aren't aware of what a SPAC is, it's a special acquisition company. So what it is shares on the stock exchange of a company that says in the future they're going to merge with another company. So at this point, you're investing in a SPAC that doesn't even tell you yet what they're going to invest in. So it's called a blank check company.
Well, I don't participate at all, and I think the world would be better off without them. I think this kind of crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble. It's just that the investment banking profession will sell shit as long as shit can be sold.
Okay, so clearly not a fan of the SPACs and the crazy frenzied purchasing that goes on. These SPACs often start at $10, and before they've even announced what company they're going to merge with to go public, they're already at $40, $50, $100. So it's been kind of crazy. So the next important question that he answered was about still owning stocks in these highly speculative bubble times. You've been quoted in the past as saying, it takes character to sell your stocks and sit in cash and do nothing, but I didn't get rich going after mediocre opportunities, end quote. In the past years, equity prices have gone up significantly, but cash has arguably become riskier due to central bank actions. In other words, insane levels of money printing. Do you believe that it's time to amend this quote?
Well, I think everybody is willing to hold stocks at higher price earnings multiples when interest rates are as low as they are now. And so I don't think it's necessarily crazy that good companies sell at way higher multiples than they used to. On the other hand, as you say, I didn't get rich by buying stocks at high price earnings multiples in the midst of crazy speculative booms. And I'm not going to change. I am more willing to hold stocks at high multiples than I would be if interest rates were a lot lower. Everybody is.
So there you go, the wise words of Charlie Munger. Now, if you want to watch the whole 2-hour televised event, you can go online and see that at either Yahoo or I believe the Daily Journal website. But I just took out some key points. Generally, what he's saying is, yes, we are in a speculative bubble, but of course, nobody knows when the bubble will pop. So they still do own quite a few shares. Now, obviously, they're value investors, so they've probably sold off a lot of the real high flyers. They're keeping their value stocks. Only because with record low interest rates, they're willing to put up with slightly higher PE ratios and continue to hold than they normally would. Okay, so we pretty much ruled out stocks as a good option right now. Now, like I said, normally when stocks aren't crazy high, they are a good opportunity to get ahead of inflation, but not right now. So the next thing, very quickly, is what about bonds? Let's just look at the screen here. It's self-evident. Bonds, 3 months, you lock up for, you're getting nothing, 0.01%. I mean, you don't even get anywhere near 1% until you lock in for 5 years. Then you're 0.98%. These are up to date. They used to be much lower. The 10-year used to be under 1%. And that's why the Nasdaq's already started rolling over. It's because when it went from below 1% all the way to above 1.5, those high PE stocks started to panic a little bit. Like, we can't keep these PEs this high if interest rates go up above, let's say, 1.5%, 2%. It's already at 1.72%. But still, think of that. You got to lock in your money with the government for 10 years to get 1.72%, which everybody's got to agree is below the rate of inflation. So you're losing money by buying US bonds. And even at 30 years, you want to lock in your money for 30 years just to get 2.36%? I don't. So let's just all agree, bonds are not a good investment at this time. Okay, what about gold and silver? And I think you already know what my answer is going to be to this. Gold has always outperformed over the long run inflation. So if you're worried about just inflation and you don't want to talk about cryptocurrencies, it's blowing your mind, can't understand it, don't want to know about it, then your safest bet is to own physical silver and gold. Why physical as opposed to the GLD or the SLV on the stock exchange? Because those are paper gold that at any time some weird thing could happen. If the economy collapsed, would the .GLD or the .SLV even have enough silver to pay out the people that bought the stocks? I don't think so. In fact, I think SLV even changed their perspective because lately it's been harder to get physical silver than people buying stocks of a silver ETF. So millions of people could buy the ETF and the ETF will just keep issuing shares, but they don't have enough physical in the back in the vault to pay for it all. And I think that's a concern. So to be truly safe, get yourself physical silver and gold. And who better to tell you that than Lynette Zhang? She's on YouTube channels. She's guests on all sorts of business TV channels talking about the benefits of owning silver and gold. I totally believe in everything she says. She sounds like what I would say if I was on TV. And she's very animated in the way she stresses it. So if you haven't seen her, it'll be interesting for you. But I really agree with everything she says. So let's pay attention to what she says on this topic.
I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer. And I really hope that you have your physical gold and silver already established because inflation, obvious inflation, is definitely on its way. And we just passed almost a $2 trillion stimulus bill on top of all the other ones that we've passed. And we're going into an infrastructure bill that is going to add roughly another $3 trillion. How are these things going to be paid for? More and more debt. But ultimately, it has to be passed on to the taxpayer. And that is part of the inflation too. And that's why I said at the beginning of the show, you better have your gold and your silver. Here, we'll get a little bit more into it. Biden team hones $3 trillion plan to ignite growth. Focus shifts to infrastructure and climate. Look, they've been pulling out this infrastructure card for quite some time. So I'm going to be doing a piece on that in the very near future so you can see about the promises and how, they would bring it out, but then not really go through with it. And we'll see if this is going to be the same this time. But dealerships run low on inventory as chip crisis curbs auto output. So you're looking at prices on automobiles, which frankly, in my opinion, are sky high anyway. I did a thing showing how much more the cost of raw materials were to produce cars today than they were a year ago. Well, they're saying that all of this money printing is not causing inflation, but of course we know that is a lie. And how many times can you be lied to if you do not know the truth? It is imperative and critical, in my opinion, that you do your due diligence and you pay attention, because you are not going to be told the truth. The truth will be hidden. And we were warned when they went to an average inflation target that inflation was coming, and they knew that they were going to, I don't know that I'm going to say allow it to run hot, or more that it's going to get away from them. And so when they sit back and they're all calm and not worried about inflation, I'm not worried about this, it's transitory. Right, and we still have 11 cent a loaf bread, don't we? No, it's not transitory. The rate and speed of the inflation was the real trick that the central bankers utilized, and why they've managed for this fiat money system to last as long as it has. But it has run its course, and you guys know we have to shift into a new system. Now, hopefully it's one that is a lot more fair, but that's only going to be true if we pay attention so that we can hold the government and the central bankers' toes to the fire. And we get maybe others in there that are more attuned to a more fair monetary system. Abraham Sanchez knew exactly how he wanted to spend his stimulus check. Like millions of Americans, he had begun dabbling in the stock market during the pandemic. So soon after $1,400 from the federal government landed in his bank account last week, Mr. Sanchez, a 28-year-old trumpet player in Sacramento, moved all but $200 of it into his Robinhood online trading account. He then used most of it to buy 80 shares of AMC Entertainment, the struggling movie theater chain. I was like, you know what? Whatever. I'll give it a shot. Now look, something that always happens before a major market correction, and we aren't talking about 10 or 20%, we're talking about 1929, 2008, 1999, is that the naive public gets involved. So while I would absolutely 100% like everybody to be educated in what money is, what its function is, and know how to really utilize it, what I think is really happening here is the naive population getting involved in it and their wealth going voop. But the stimulus checks are, when you start hearing how great this economy is growing, you got to realize that it is happening on the back of massive debt. And at some point, that debt must get repaid. You either have to, pay it or roll it over or default on it. That's what hyperinflation is about for governments and central banks. It's hyperinflating the value away. The only difference between inflation and hyperinflation is the speed of that inflation. That's what you have to pay attention to. That's why you have to have gold and silver. Today, we're going to go over how gold and silver perform during currency resets, because that's what I personally am really looking at. Anything other than that is kind of just a short-term trade. And what are you going to trade things into? Fiat money? I mean, That's crazy talk, to be perfectly honest with you. Unless, of course, you're going to pay off a mortgage or you're going to buy something, you can only use fiat money. But this is the time to be accumulating, actually, both gold and silver, but for very different reasons. So let's take a look at that. And, I've been talking about Venezuela. Here we go, one more time, because this is something that's happening right away. But in 2018 was the first currency reset in Venezuela. And silver certainly performed quite well, as did gold. However, let's take a look at that. So silver went up substantially. Let's see, hundreds, thousands, millions, so almost 3.5 million%. That's pretty good. Who's going to complain about that in terms of the Bolivar? But here's how gold performed. This is the first reset. They recently had the second reset. We're going to look at that next. But certainly in terms of the currency, gold outperforms silver at a pretty significant level. Why? Because gold is the primary currency metal. What do the central banks hold in reserve? They hold gold. So that at the end of the day, when they reset that currency against it, they reset it against gold. But globally, on average, we will likely see 3 of these before the entire economy is reduced to a full barter economy. That's why silver is important, is for your day-to-day barterability. So you can buy that pint of strawberries. You can put a tank of gas in your car. But how easy do you think it would be to buy a building with that? You need an awful lot of them in order to buy a building. That's why I use gold for my opportunity positioning as well as wealth preservation. You need both, but they both have different functions. And you have to really ask yourself, what do you want to be holding into a currency reset? For me, it is I have both. I want both. You need both. But you need this to sustain your standard of living. You need this to grow your wealth base and to protect all of those fiat dollars that you might not be able to move out of your 401k or out of your IRA or your 403b or your pension plan. And I hope you are not counting on those instruments to see you through this, because anything that you can only convert into, in this country, dollars, well, last time I checked, 1 trillion times 0 is 0. If the dollar has no purchasing power, just like the Bolivars, if they have no purchasing power, you can have a gazillion of them, and it's not going to matter. Because we all know that food becomes the biggest issue for people during these transitions. And even if you stop and think about what happened in March of last year, a year ago, when all the grocery store shelves went bare, well, toilet paper is also a really important thing to have on hand. And as you probably saw, you can also barter with that. But the difference between silver and, say, toilet paper or berries or any kind of food stuff is that food stuff has a shelf life, whereas silver does not have a shelf life. I mean, I don't know how old this is, but, I picked this up at a yard sale, God knows how many years ago.
Okay, good stuff there from Lynette, and I got to thank her and ITM for letting me use that footage. Now, one thing she mentioned there that I think is a good point that I hadn't mentioned yet is don't think that I'm happy about what I'm saying is going to happen. This out of control inflation and this maybe the US dollar collapsing and not being the world currency and all that stuff. this is not good for me. I do not want this because I have a pension that I cannot control. It's not like it's my money in my investment account that I can do what I want with. I can put it all into crypto. I can put it all into mining stocks. I can't. My pension is controlled by the pension board. They invest it wherever they want, and it's always going to be in fiat currency. So when I retire in 3 years, they're going to give me a certain percentage of my best 5 years' salary. So when I get that money, the problem is if inflation by this point is 10, 15%, but the government's still saying it's 3%, my pension's only going to go up by 3%. And I'm going to constantly lose purchasing power every year. And if hyperinflation happens, heaven forbid, it goes to 20, 30, 100, 3,000%, my pension will be worth nothing in probably a year. So I, heaven forbid, hope that that doesn't happen. So don't think I'm taking some sort of joy out of telling you that this might happen. I'm just trying to let you learn that this is a possibility, and you might want to take any money you can control and put it in some other assets. There you go. Just thought I'd let you know that. Gold and silver companies is a leverage play on gold and silver. So it's another option. So if you have a retirement savings account and you want to put something, you have to put stocks in there or something like that, and you don't want to put those high priced tech stocks in there anymore, you start to look at these gold mining stocks, which never got love during this whole bull market. They've gone up, and I don't have any gold companies in my portfolio that have lost me money, but they haven't gone up in leaps and bounds like the tech companies have. Had I known when I liquidated out of the tech companies and put into mining companies, if I'd known what I know now, I wouldn't have done it, of course, because I've made money, but I haven't made as much money as I could have if I just stayed in Apple, and heaven forbid, I would probably not have thought of it, but Tesla, I would have made a lot of money. Long and short, I've got mining companies, and I've got new crypto mining companies now, which is a new slant. We'll get to crypto in a second. But the reason it's a leverage play on gold and silver is because their all-in sustaining costs of a mine are pretty stable. Like year over year, their cost of running the trucks and keeping, paying employees and all this stuff stays fairly stable. So when they're selling gold at $1,400 an ounce and their all-in sustaining cost is $800 an ounce, they make $600 an ounce. The leverage part is if gold starts going up, like it should, I think it should be at least $5,000 an ounce by now. If inflation was really being realized by the public, they'd be running into gold. They probably would continue to run into cryptocurrencies. They'll be running out of the fiat currency. And if that happens, gold will go up. So if it went up to $2,000 an ounce, which is not that far from where it is now, then instead of making $600 an ounce, they're making $1,200 an ounce. The cost of running the mine really hasn't changed much, but the right to the bottom line profits for the company go through the roof. So yeah, I've got a lot of mining companies, and I do believe when gold is finally getting the love that it deserves, the mining companies will go back to getting the love that they deserve. So there we go. So this is going to be the last part of this presentation. It's gone on long enough, so this is such a huge topic that I can't really get into cryptocurrency the way I want. So I'm going to do a totally different episode after this on my Investing with Craig channel, my brand new channel. And it's going to go a lot more detail into cryptocurrencies. But what it is, it's a decentralized form of currency. What it happens is you have a digital wallet, which is free to make. You can go online and create a digital wallet, and then you can put money, you can transfer money. It's not as easy as I would like it to be, but you can transfer money from your bank to a crypto exchange. You can buy, let's say, Bitcoin or Ethereum or whatever, and you put it in your digital wallet. Now, at first, that's all I did back in August 2018. I put 10,000 Canadian dollars into a crypto exchange, and I had Bitcoin at first, and then I diversified into some other altcoins. And then I just sort of left it there because I didn't know enough about it to know what I could do with it that I know now that I've spent all this time researching it. Long and short, it's done gangbusters for me. But here's what I was going to say. I'll have a digital wallet and you have a digital wallet. If I want to send you money, I electronically send it to your wallet, and I've got the number, like you send, or I get the number, I copy it and put it into my thing. This is the wallet I'm sending it to. Within a minute or two, you got the money, and it's decentralized. There's no bank in the middle. There's no clearinghouse in the middle. There's no fees for transferring a coin to one person to another. There are fees for buying one coin from another coin because there's a transaction that has to go in there, and that's where the crypto exchanges make some money. But I use Kraken and Binance, and just using Binance, they have amazingly low fees. Like I think it's 0.1% fee for, let's say, me buying Ethereum from Bitcoin or something, So it's amazing. It is the future. And so many companies are jumping on board now. Visa's now accepting it as a way of purchasing and buying products with Bitcoin. Tesla has now let you buy a Tesla with Bitcoin. Goldman Sachs is going to let their clients, the high net worth clients for now, buy Bitcoin. And as time goes by, they'll let every client do it. A bunch of the other banks are doing it. I don't want to waste time listing all the things, but there's so much more adoption now than there was even 6 months ago that I think this is just the start of the cryptocurrency movement. Right now, the whole cryptocurrency market, every coin, is $1.1 trillion. The whole gold market, which has always been perceived as extremely small, is 11 trillion. So even if cryptocurrency grew to the size of the gold market, it's got to go up almost 11 times. And then again, I think gold's got to go up too. It's undervalued. So let's say gold goes from 11 trillion to 20 trillion. Then let's say cryptocurrency catches up with gold. Crypto has to go from 1.1 trillion to 20 trillion. So if you think that the gains that I've gotten so far are high, I don't think we're in the first inning. Maybe we're in the first bat of the first inning in terms of cryptocurrency, now that a lot of corporations are getting on board. Here is, just to show you, this is what I say, to the moon. This is where I bought my cryptocurrency back here. I bought Bitcoin at $6,200. I must have cropped off the side of the graph. Just believe me over here. This is $6,200 over here. And I bought that in 2018, August, and it went along. It's funny, back then, these rises looked huge back then. Like I remember when it got up here, I was like, wow, I'm making so much money. And then it's just gone parabolic ever since then. So right now we're at around 58, 59,000. Over here we got to about, I think 61,000, almost 62,000. It always does that. It goes up and then it takes a breather. Then it goes up and then it takes a breather. But it's always higher highs, higher lows. Even from back here, it's never been a lower low. It's just been constantly a higher low and a higher low and a higher low and a higher low. And that's because of adoption. Back here, Bitcoin was still kind of considered a little on the risky side because you're always worried what happens if the government slams the door on it. If anybody's ever seen buying anything with a Bitcoin, you can get arrested. That was still very unlikely, but there was still that 1% chance that could happen. Now I just don't see it. So many corporations have put it on their balance sheet. It's just so many that I don't think the government now, the genie's out of the bottle. They couldn't do anything now to stop it if they wanted to. It's like trying to say they're going to stop the internet. It's just not doable. So here's one thing, just quickly, a little taste of what I'm going to show you in a future episode. What can you do with your cryptocurrency to make passive income, and a good passive income, that you can't do with gold? If I have gold and I have gold bars, for argument's sake, or gold coins, and I just stick it in a vault, I don't make interest on my gold. I just hope that the value of gold goes up. Now, like I told you, I use Binance as my favorite crypto exchange. And Binance has its own Binance coin. It's called BNB. If you go into Binance under their staking, so there's in the earn section, and I'll show you on another episode exactly how to get in here. This just goes to show you, and if you look down here, you could expand. There's 51 other options. But my BNB coins that I have, they have a lot of utility. They're the currency of the Binance chain. They have their own chain like Ethereum, with much lower gas fees than Ethereum. So I think it's superior. And BNB or Binance has been growing in leaps and bounds, faster than Bitcoin, faster than Ethereum. But look what you can do. You can take your Binance coins and stake it. Now I've presently staked mine for 60 days and I'm making 16.49% annual rate of return. So in other words, if I rotated this every 60 days and locked it in again, I would get 16.49%. And you're not getting 16.49% dollars. You're getting 16.49% more coins. So every day you get a tiny sliver of more Binance coin that stays in the locked, and then it gets tabulated in the growth for the next day and the next day and the next day. So long and short, it's an amazing way to make not only money from your Binance coin going up in value, but you're getting more Binance coin as the days and weeks and months go by. So unbelievable. So I just wanted to mention that to you. That's Binance. There's a bunch of other coins that also have really high interest rates. If you lock in for 30 days, it's less. You make a slightly, this is a screen grab, so I can't push on the 30. But if you push on the 30, I think it was 14 point something percent. So, the longer you lock in for, the more percentage you get. So I didn't know about this. When I bought in 2018, I wish I'd really been researching. I took the coins and left it in the exchange and didn't think about it. Thought, well, it's $10,000. It's like my digital gold. And just like gold, I didn't think I could do anything with it. Now I realize Binance and Ethereum and all these are what's called proof of stake coins. So to make the whole thing, to lubricate the gears of transactions on these chains, they want people to stake the coins. That's what makes transactions available to be done. So you get rewarded for the fees that they gain. So you get a percentage of the fees that Binance gains from these transactions. So impressive. So there we go. Thanks for watching. I know it was a lot. If you got to the very end, congratulations. It's been a marathon. Give it a thumbs up if you've gotten this far. Again, be one of the very first people, because right now I have 0 subscribers on my new Investing with Craig channel. This is on the Cruising Off Duty, but do me a solid. Go over to Investing with Craig and subscribe there so that when I put in the time and effort to make these episodes, it isn't for 3 people. Okay, and when send me in the comments over there, if you sign up and you say, "Oh my God, I'm subscriber number 10," I'd just be funny to see people putting in there for all time to see that you are my 5th subscriber or my 10th subscriber. It's pretty funny. It's kind of daunting because I remember what it was like when I first opened the Cruising Off Duty website or YouTube channel, and I remember being so happy to get to 50 subscribers. It was so, am I ever going to get to 100? And then it took off. So there's that like the snowball rolling down the hill. You got to get it going because we're all the same, right? You go on YouTube, you pick a topic in the search bar, and it gives you a list of videos. And if there's one that has 50,000 views and one that has 150 views, you never watch the one with 150 views. You always watch the one with 50,000 views. You just assume, hey, if 50,000 people wanted to watch it, it must be good. And the one that's got 150 views, probably crap. So got to get over that hurdle. And I guess I've got the philosophy that I did it once and I can do it again. And maybe I can get the Investing with Craig channel to be even bigger than Cruising Off Duty. So let's hope. Anyways, I really enjoy giving this kind of educational content. It is always educational. I'm not your financial planner. So anything I tell you on here, do your own research. Don't invest on anything that somebody on the internet tells you to do. Do your own due diligence and your own research. Stay safe, stay happy, stay healthy, and let's try and create some wealth together. So until next time, this is Craig signing off, wishing you safe investing.